It was a shock in red. On a quiet afternoon in Tokyo, the Nikkei stock index suddenly plunged, screens at the exchange flashing scarlet. Traders stood frozen, staring at numbers sliding off the cliff. No earthquake rattled the city. No scandal spilled from a tech giant's earnings call. The culprit was hidden in plain sight. The yen, Japan's currency, and a secret trade built on borrowing it. This was not just a local hiccup. It felt like a fuse being lit under global markets, a reminder that one tiny twist in Tokyo could send ripples worldwide. For decades, Japan kept its borrowing costs near zero, sometimes even below. Meanwhile, elsewhere, bonds and bank rates have crept into the mid-single digits. That gap created an irresistible idea. Borrow yen at rock-bottom rates, convert them to other currencies, and invest in higher-yielding assets. In plain terms, you take out a loan in Japan for almost nothing and buy, say, a 5% US Treasury. The difference is nearly pure profit. This is called the carry trade. On paper, it sounds like free money, and for years, practically everyone, from hedge funds to ordinary borrowers, believed it. People even used cheap yen loans to pay off mortgages overseas. The strategy was so popular that it quietly underpinned markets around the world. Inside the Tokyo Stock Exchange's trading floor, the hum of computers has replaced shouting traders, but the market's pulse is still beating. This floor was built on one assumption: Japan's money would always stay cheap. That belief is now breaking. In early 2024, the Bank of Japan finally said goodbye to negative rates. It nudged the policy rate to zero, then slowly lifted it again. By late 2025, that rate hit 0.75%. Many think 1.0% is coming soon. Each small increase sounds tiny. After all, 0.75% still seems low, but the meaning is enormous. It means Japan is normalizing policy, and that means the old world where borrowing yen is free is ending. Here's the rub. Those years of near-zero rates let a mountain of bets build up worldwide. Imagine making 4% or 5% per year without risking a dime of your own cash, as long as nothing changed. At one point, an investor could borrow yen for 0.5% and lend dollars at 5.5%. That's nearly 5% in your pocket, risk-free, a yield any pension fund dreams of. The math was almost trivial. Borrow $1 million worth of yen for 0.5% interest, invested in a 5.5% bond, and you pocket $45,000 a year. Load that up with leverage, rinse and repeat. As long as the exchange rate stayed stable, everyone won. Traders piled in worldwide, stacking yen short positions like chips in a casino.
But there's always a catch. If the yen starts to strengthen, even a little, the profits vanish. Picture this. The dollar is trading at 160 yen. Suddenly, it moves to 145 yen. In a flash, your yen debt is 9% more expensive in dollar terms. That can wipe out an entire year's gain in the carry trade. In fact, just such a move happened in mid-2024. After a hint from Tokyo policymakers, the yen shot up about 12% against the dollar in a matter of days. The 4 to 5% cushion carry traders had built evaporated. Those free, risky bets became scalding hot. We've seen this movie before. Every time global markets have panicked, 2008's financial crisis, the Brexit scare, even the COVID crash of 2020, the yen has spiked as traders peeled off carry positions, and each time the shock felt global. But August 2024 was a preview of something else, a carry trade unwinding on steroids. In one day, Japanese stocks fell faster than on Black Monday 1987. Wall Street wobbled. Traders on every continent murmured, "Watch the yen." It wasn't a blow-up in tech or housing that day. It was this quiet foreign exchange strategy imploding. Now consider the scale.
How big is this carry trade? Opinions vary. Some analysts insist it's relatively small, a few $100 billion at most. For perspective, Japan's net foreign assets are about $3.6 trillion, so any money coming home can indeed move markets. Others say, look at the evidence. If even a fraction of those holdings turn into panic selling, yields and prices will jump everywhere. One recent analysis puts the active yen carry at roughly $250 to $300 billion. Another puts it higher. Either way, the key isn't the headline number, it's the dynamic. A highly leveraged stack of trades, however sized, can still trigger cascading moves. What makes this moment especially nerve-wracking is the timing. The Bank of Japan is on the verge of more rate hikes. Forecasts suggest a full % is on the table by spring 2026. At the same time, other central banks, like the US Federal Reserve, hint that their tightening cycle is ending or even reversing. That's dangerous. A narrowing of the interest gap between Japan and, say, the US means less incentive to stay short yen. If the Fed pauses or cuts while Tokyo ticks upwards, the flows reverse. Fast. Traders might rush to unwind. One day, the global bond market could be awash with liquidity. The next, a spike in USD JPY could dry it up. What would a global ripple look like? Imagine holders of US Treasuries, seeing their loaned yen become pricey, suddenly decide to sell dollars to buy yen. That pushes US bond prices down, yields up. If yields jump, borrowing costs everywhere rise. Mortgages go up, corporate loans get tighter, governments feel the squeeze on debt service. At the same time, investors rotating out of dollar assets sell stocks and cryptocurrencies. On the other hand, a stronger yen could make imports cheaper for Japan, helping its economy, but many Japanese exporters and investors would feel the pain. The cross-currents get complex. Essentially, a sharp yen move forces a scramble. Anyone who used yen as funding must find yen to repay, and they'll sell whatever liquid asset they can, anywhere in the world.
Some experts downplay the doom scenario. Headlines have asked, is this 2008 all over again? A recent financial column argued that what happened looks more like a normal volatility event, not a world-ending crisis. Maybe, but it's hard to ignore what happened the last time these lines crossed. In interviews, some strategists warned that a full unwinding of yen bets could drain liquidity from U.S. assets. One trader colorfully said the carry unwind was market Armageddon, not because stocks ended the day in a crater, but because it showed how delicate the status quo has become. Behind closed doors, policymakers are watching. Tokyo's finance minister and the US Treasury have even put out joint statements. Markets should be free and stable, and they'll step in only to fix disorderly moves. Yet Japan itself is under pressure to spend and tax cut, even as it normalizes monetary policy. Japan's public debt is enormous, over 200% of GDP, and rising security budgets mean lots of bond issuance. If yields stay low, fine, but a sudden market-driven rise could make that debt unsustainable. Japan has about $1.4 trillion in foreign reserves, a war chest it could theoretically use to smooth yen moves. But tapping those reserves to defend the yen could undermine confidence, send the opposite signal, or anger trading partners. Ironically, it's as if global markets built a skyscraper on a foundation of cheap yen. For years, it's been stable, barely shaking. Now the ground is shifting and cracks are showing. The risky thing is, nobody knows exactly how deep they go. Will Tokyo's next move be a controlled descent or a trap door? The data alone can't say. The real answer will come only with time and reaction. One thing is for sure. This carry trade was always a double-edged sword. In calm weather, it fuels growth and investment. Japanese savers earn higher returns abroad, and dollars keep flowing into risk assets here. But in a storm, it can amplify the shock. A small tilt in currency suddenly forces giant funds to rush exits, selling indiscriminately. There's a simple metaphor. It's like standing too close to a bonfire. As long as nothing blows too hard, you enjoy the warmth, but one gust and you get scorched. So here we are at the edge of that bonfire. Tokyo has started to stoke it by raising rates. The rest of the world is watching. Will the fire stay small, a useful comfort, or will it leap out, engulfing markets far beyond Japan's shores? That's the question investors, governments, and even ordinary people are grappling with. There's no neat conclusion, no easy answer. The truth is uncomfortable. One nation's interest rate decision can influence your retirement portfolio and your mortgage rate. Carry traders may not wear masks or emblazon logos, but their bets form a silent web holding global finance together. If that web snaps, the world could jerk in unexpected ways. So as the Bank of Japan meets again, markets will hold their breath. A dramatic collapse or just a blip? We don't know. What we do know is this. In an interconnected world, even a small shift in Tokyo can have a big impact here. The next question hanging in the air is simple and stark. When the Tokyo domino falls, how big will the tremor be? Only time will tell.